Welcome to our series on mutual funds and ETFs. Today, we're exploring one of the most popular investment vehicles available to everyday investors: mutual funds. Mutual funds represent a powerful way for individuals with limited capital to participate in the financial markets. They offer three core benefits: collective investment, where many people pool their money together; diversified portfolios, which spread risk across multiple investments; and professional management, where experts handle the complex decisions. By the end of this video, you'll understand how mutual funds make sophisticated investing accessible to everyone. At its core, a mutual fund is an investment vehicle that collects money from multiple investors and uses that combined capital to purchase a diversified portfolio of securities. Think of it as a financial pool where individual investors contribute their money, and that collective fund is then invested across various assets. The flow is simple. Individual investors put their money in, it gets pooled together, and then it's invested in the market. This pooling mechanism is what makes mutual funds so powerful for small investors who might not have enough capital to build a diversified portfolio on their own. Let's break down the pooling process. Imagine three investors: Investor A, Investor B, and Investor C. Each of them might have only a modest amount to invest, perhaps a few $1,000s. Individually, their capital is limited. However, when they pool their money together into a mutual fund, along with potentially thousands of other investors, they create a substantial pool of capital. This combined fund now has significant purchasing power, allowing access to a wide range of investments that would be impossible for any single small investor to achieve alone. The mutual fund acts as the central vehicle that aggregates all this capital and manages it collectively. One of the greatest advantages of mutual funds is professional management. When you invest in a mutual fund, your money is managed by experienced fund managers who are experts in financial markets. These professionals dedicate their careers to analyzing market trends, researching companies, and making informed investment decisions. They continuously conduct research and analysis, monitoring the market and optimizing the portfolio to achieve the fund's objectives. For individual investors, especially beginners, this means you don't need to become a market expert yourself. You're essentially hiring professionals to do the complex work of selecting and managing investments on your behalf. Diversification is a critical concept in investing, and mutual funds excel at providing it. Consider an individual investor with limited capital. They might only be able to afford shares in one or two companies, which means their entire investment is concentrated in a very small number of holdings. This concentration creates significant risk. Now compare that to a mutual fund, which can hold hundreds or even thousands of different securities across multiple sectors and industries. If one company or sector underperforms, the impact on the overall portfolio is minimized because the fund is spread across so many other investments. This diversification dramatically reduces risk while maintaining growth potential. Mutual funds can invest in a wide variety of asset types, giving investors exposure to different segments of the financial markets. They commonly invest in stocks, which are shares of companies offering growth potential. They also invest in bonds, which are debt securities issued by governments or corporations that provide regular income. Money market instruments offer short-term, low-risk options for capital preservation. Some mutual funds invest in real estate through REITs or real estate investment trusts. Others may include commodities like gold or oil. Many funds use a mixed asset approach, combining different types of investments to balance risk and return. This variety allows investors to choose funds that match their financial goals and risk tolerance. Mutual funds offer several compelling benefits specifically for small investors. First, they have a low entry point, meaning you can start investing with minimal capital, often just a few $100s. Second, they provide risk reduction through diversification, spreading your investment across multiple securities rather than concentrating it in just one or two. Third, mutual funds offer excellent liquidity, meaning you can easily buy and sell your fund units when you need to access your money. Finally, you gain access to professional expertise without needing deep market knowledge yourself. The fund managers handle all the complex decisions, making mutual funds an ideal starting point for beginning investors who want to grow their wealth without becoming market experts. Here's the most important thing to remember. Mutual funds democratize investing. They level the playing field by giving small investors access to the same type of professionally managed, diversified portfolios that were once available only to wealthy individuals and institutions. Whether you're saving for retirement, building an emergency fund, or working toward any other financial goal, mutual funds provide an accessible, efficient way to participate in the financial markets. They remove many of the barriers that traditionally prevented everyday people from building wealth through investing. By pooling resources with other investors, you gain the benefits of professional management, broad diversification, and economies of scale. Mutual funds truly make sophisticated investing available to everyone.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.